Imagine you are a parent and your kid comes back and says, look, I've got really bad marks in an exam. Let's say that it's not his fault. The paper was tough, or his school bus arrived late, or something went wrong. But the bottom line is that the marks are terrible. How would you react as a parent? On the one hand, you don't want to scold him too much for something that you know was not in his hands. That would unnecessarily demotivate him. But on the other hand, if you sound too relaxed, he might end up thinking that it's okay to get bad marks. So the RBI had this dilemma in the run-up to the August policy meeting. So basically the RBI has a 6-member committee called the Monetary Policy Committee. It meets once every 2 months to decide whether the policy interest rate is to be increased to control inflation or decreased if inflation is no longer a problem but growth is slowing down too much, or be kept where it is. For this, once every 2 months, the RBI essentially has a deep dive discussion with the nation on what's happening to inflation, what's happening to growth, forecast what will happen over the course of the next 1 year, figure out how global conditions have changed, and then the committee decides on what to do with interest rates. Now, so far, the RBI has raised interest rates from 4% last year to 6.5% early this year and has kept it constant there. And that's primarily because inflation has started to come off from around 6.5 to 7.5% in the middle of last year to around 4 to 5% as of June. Mind you, the RBI has a target of 4% and it can tolerate inflation up to 6%. Now, the problem for the RBI is that the inflation kid failed in the July exam. Tomato prices skyrocketed by over 200% in a month. We've in fact also seen other vegetable prices pick up sharply, as well as prices of cereals and pulses. In fact, we've done an episode of the Bond Economist on tomato prices and inflation. I'll leave a link at the end. Do check it out. Food inflation shot up so high that the overall inflation for July is all set to shoot up. Now, at the time of filming this video, the July inflation data was yet to be released, but market is expecting it to be around 6.4%, up from 4.8% in June. Mind you, 6.4% is higher than the RBI's upper tolerance band of 6%. And, well, of course, it's 2.5% higher than the RBI's 4% target. So the RBI's dilemma is this. See, central bank's main job is to control inflation. And to do that job, it has to be seen serious about the job. Remember, we used to have school teachers who were super strict and had a reputation of not tolerating any nonsense. They just had to give one glare to the class and everyone would stop talking. But if your credibility of class control was low, you would have to do far more, shout, threaten, punish in order to get the same class to respect your authority. Same goes for the RBI. When people are convinced that the RBI is strict against higher inflation, that is, whenever inflation goes beyond the RBI's comfort zone, it is ready to raise interest rates, then people have confidence that the RBI won't allow prices to rise too much in the future. On the other hand, if people expect prices to sharply rise tomorrow, then they end up hoarding things today, which causes current prices to rise. So it's very important for the RBI, or as a matter of fact, any central bank, to convince the public that it has a no-nonsense attitude towards higher inflation. Because if that's not the case, then let's say the RBI hikes interest rates by 1%. But people still think that the RBI has no handle on inflation and inflation expectations continue to inch higher. That in turn leads to higher prices today, which in turn leads to the RBI having to raise interest rates even higher to control inflation today. And in the process, growth gets really screwed. Now, on the one hand, the governor sitting in Mumbai cannot control vegetable prices in mandis across India. So what's the point in raising interest rates? Because especially other goods and services have already seen a sharp fall in inflationary momentum. But on the flip side, neither does the RBI want to give you the impression that it is sleeping at the wheel. Or else today food prices are up, tomorrow people might expect other prices to go up, and suddenly the RBI could find itself in a position where retailers are starting to raise prices of everything from footwear to suitcases to cinema tickets. And then it would become an RBI problem, because then it would need to increase interest rates to slow down growth and control this inflation. This spread of inflation from supply side factors like food to the rest of the economy is what in economics is known as generalization of inflation. And it's any central bank's worst nightmare. So what did the RBI ultimately choose to do in its recent August policy meeting? Well, it sounded hawkish, which is basically to glare like that strict class teacher and say that we will rain hellfire if we see any signs of generalization of inflation. But at the same time, also saying that, look, we know that the spike in veggie prices is temporary, so for now we are ready to tolerate it. But only for now. But even as the RBI didn't raise interest rates, it kind of did. And this is where the concept of liquidity comes in. So when the recent demonetization of 2000 rupee notes happened, we ever wondered what really happened to all that currency? Well, the way it works is that we deposited our money in banks. So the funds available with banks swelled. Now, banks are in the business of lending. They not only lend to the likes of us for buying homes and cars and to companies and the government, but they also lend to each other. So when there's excess of money floating in their banking system, which is roughly what liquidity means. I mean, there's a lot more nuance to this, but this is one simple way to think about it. So when there's lots of money sloshing among banks, then what happens? The interest rate they charge each other for short-term borrowing falls. This is called the interbank call money rate. Like any market, if there's an excess of something, the cost of that goes down. And because everything is linked to each other in the economy, if the call money rate goes down, then other interest rates, including the ones we pay as consumers, will eventually feel some degree of impact. And mind you, interest rates eventually impact growth, which in turn impacts inflation. So the last thing that the RBI wants is that on the one hand, it is keeping policy interest rates high to control inflation. And on the other hand, banks are so much slosh with funds from people depositing these 2000 rupee notes that in turn is pushing down interest rates. So initially the RBI said, okay, bankers, I'm going to drain out some of this liquidity. So let me offer you to park your money with me for a few days for a decently remunerative interest rate. Now this is called variable rate reverse repo operation, or VRRR. And how can you tell someone you don't work in financial markets without actually telling them you don't work in markets? Pronounce this as VRRR. But the problem for the RBI is that the banks didn't want to let go of these excess funds. For whatever reason, they were like, no, thank you. We are okay. We are okay holding this money on our own. And so short-term interest rates were facing downward pressure at a time when the RBI is trying to firefight inflation by raising interest rates high. So what did the RBI do? Well, when the carrot doesn't work, you essentially use the stick. So India has something known as the cash reserve ratio, CRR. Banks have to compulsorily park some amount of their deposits as cash reserves with the RBI on which they don't earn any interest rate. That's currently at 4.5%. So naturally, when you raise the CRR, right, so banks can lend a lesser part of their deposits, which then puts upward pressure on interest rates. So the RBI is like, look, I was offering you such remunerative rates to park your money with me under the VRRR operation, but you ignored me. Okay, so here's what I'm going to do. I am not only going to drain away that money, but guess what? You won't get any interest on it. So in the August meeting, the RBI announced that whatever increase in deposits banks got because of the 2000 rupee notes coming back, 10% of it has to be additionally kept with the RBI as incremental cash reserves. And the RBI said that, look, it's temporary for now. In early September, we'll see what to do about it. And this hits banks, right? Because banks could have used these deposits to lend. They could have invested it in government bonds, earned interest on it. Instead, now it will be locked in with the RBI with no interest income for a month. But for the RBI, this works charmingly well. It wanted to suck out around ₹1 trillion or so from the banking sector. So this was a surgical strike. And remember, the RBI's original problem is that inflation is increasing. So doing this will keep upward pressure on short-term interest rates because there's much lesser liquidity in the system. Moral of the story for banks is that don't take panga against the RBI. So what happens next? Well, the RBI raised its inflation forecast for FY24 from 5.1% to 5.4%, which is quite a lot of change in just 2 months. But it has its 1 year ahead inflation expectation at 5.2%. And so the real interest rate, which is the nominal interest rate now, 6.5%, adjusted for this 1 year ahead expected inflation at 5.2%. 6.5 minus 5.2 is 1.3%. And the concern is that the 1.3% real interest rate might turn out to be too high for our growth to sustain. In fact, one of the 6 MPC members, that is the Monetary Policy Committee members, Professor Jayant Verma, said in the June policy meeting that the real interest rate, and I quote, is close to levels at which it can inflict significant damage to the economy. So while the RBI firefights inflation now, the real burning smell that it needs to be careful about is the one that could potentially come from growth. For more such insights, please like, share, and subscribe to The Bond Economist.